The equity statement sat unopened on the dining table for 3 weeks, while the rest of the mail was sorted and filed. The house had been theirs for almost 12 years by then. The mortgage payment no longer felt new. It was simply another fixed line in the monthly flow of money: principal, interest, property taxes, homeowners insurance bundled into one automatic withdrawal that cleared on the second business day of each month. They had refinanced once when rates dropped years earlier, stretching the term back out to keep the payment manageable while daycare costs were at their peak. At the time, it had felt measured and responsible. The equity statement came quarterly. It showed a number that had grown steadily as home values across their region climbed. On paper, their net worth looked stronger each year. The house appreciated faster than their salaries. Retirement accounts rose and fell with the market, but the home value chart moved in a mostly upward direction. Friends spoke about housing gains the way previous generations talked about pensions. Still, the statement remained unopened. In their mid 40s, income had stabilized. Promotions had come and plateaued. Annual raises were modest, usually in line with inflation, sometimes slightly below. Health insurance premiums crept upward every January. The 401k contributions were steady, set years earlier at a percentage that felt ambitious at the time, and now simply felt necessary. College savings contributions ran automatically to two separate 529 accounts. Car insurance adjusted annually. Property taxes rose every reassessment cycle. They owned more than they once had: a home in a well regarded school district, two vehicles, both financed at different times, one paid off and one still carrying a balance. Retirement accounts that had crossed into six figures. A modest brokerage account funded during bonus years. Furniture bought to last. Appliances replaced as needed. A finished basement that added square footage and resale value. The balance sheet looked healthy. The checking account rarely did. Liquidity had quietly narrowed. After fixed expenses, payroll taxes, retirement contributions, insurance deductions, and automatic transfers, what remained each month was precise. There was room for groceries, utilities, fuel, streaming subscriptions, and routine maintenance. There was room for planned vacations if they were saved for in advance. There was room for minor repairs. There was not much room for anything unplanned. The first time the realization surfaced was not dramatic. It happened when the HVAC system failed during a humid July stretch. The replacement cost was high enough to disrupt the monthly rhythm, but not high enough to justify tapping retirement accounts. They used a home equity line that had been opened years earlier, just in case. The rate was variable. The balance lingered longer than expected. On paper, the home's equity far exceeded the repair cost. In practice, the equity required debt to access. The following year, one of the children needed orthodontic treatment not fully covered by insurance. Payment plans were offered, interest-free for a set period. They enrolled. The monthly amount was manageable, but it layered onto the existing obligations without replacing anything else. Their net worth continued to rise. Cash flow did not. In earlier years, ownership had represented stability. Renting in their 20s had felt temporary, exposed to rent increases and lease renewals. Buying a home was a milestone that signaled permanence. Mortgage interest was tax deductible. Payments built equity rather than disappearing into rent. It aligned with what colleagues, parents, and financial media described as prudent adulthood. Over time, ownership accumulated invisible weight. Property taxes increased as assessed values climbed. Insurance premiums adjusted upward, after severe weather events in their region, drove claims higher across the state. Maintenance costs arrived without coordination. Roof repairs, plumbing issues, exterior painting to preserve siding and prevent long term damage. None of it was irresponsible spending. It was the cost of preserving and appreciating asset. The house became both their largest asset and their least flexible one. They could not sell it casually. It anchored school zoning, commute patterns, social networks, and proximity to aging parents. Selling would trigger transaction costs, realtor commissions, transfer taxes, moving expenses, and likely a new mortgage at prevailing interest rates. Even with appreciation, relocation carried financial friction, so the equity remained embedded. Meanwhile, retirement accounts were locked behind penalties and tax consequences until a certain age. Brokerage assets could be liquidated, but doing so meant realizing capital gains and reducing long term compounding. The emergency fund existed, but it was calibrated to cover a limited number of months of expenses, not to absorb large structural changes. Most of what they owned required time, paperwork, or debt to convert into usable cash. The realization deepened gradually. It was not about being overextended in a reckless sense. Their debt to income ratio remained within what lenders once approved. Credit scores were strong. Payments were on time. They were not living extravagantly. Vacations were domestic. Vehicles were practical. Dining out was occasional. The pressure came from the gap between visible wealth and available flexibility. Colleagues who appeared less asset heavy sometimes described more freedom in subtle ways. A coworker who rented could relocate quickly for a new job opportunity in another state. Another who had delayed buying a larger home maintained a larger cash reserve and spoke about taking a sabbatical between roles. These were not dramatic lifestyle shifts, but they hinted at optionality. Optionality had narrowed inside ownership. When a restructuring at work eliminated a management layer, the impact was immediate, but not catastrophic. Severance covered several months. Health insurance continued temporarily. The resume was updated. Interviews began. The mortgage payment did not pause. Property taxes did not pause. Insurance premiums did not pause. 529 contributions were reduced but not stopped entirely. Retirement contributions were suspended during the employment gap. The emergency fund absorbed the difference. Each withdrawal felt controlled, calculated. The house still showed a strong estimated value online. Real estate listings in their neighborhood closed above asking price. On paper, they were wealthier than ever. In the checking account, numbers moved downward. They considered selling briefly. Not because they wanted to, but because it was the only lush lever available. Selling would unlock equity, but it would also dissolve stability. Children would change schools, commutes would shift. A rental might cost nearly as much as the existing mortgage given market rents. Buying again later could mean higher rates and re-entering at a different price point. The asset that signaled security also limited maneuverability. Employment returned after several months. The salary was comparable but structured differently, with a lower base and a higher variable component. Benefits were similar, though health insurance deductibles were higher. Retirement contributions resumed, though at a slightly reduced percentage while they rebuilt the emergency fund. On performance reviews and LinkedIn profiles, the transition looked seamless. On their personal balance sheet, liquidity had been permanently thinned. Over the next few years, appreciation continued. The home crossed a valuation threshold that once felt distant. Neighbors renovated kitchens and added decks to capture resale value. Conversations at block gatherings revolved around appraisal figures and contractor timelines. They delayed cosmetic upgrades. The kitchen remained functional but dated. Cabinets were solid. Countertops were intact. Appliances worked. Renovating would likely increase resale value, but it required cash upfront or additional borrowing. The return was theoretical unless they sold. Instead, they replaced only what failed. By their early 50s, retirement projections became more frequent topics between them. Online calculators estimated comfortable outcomes if current contributions continued and markets performed within historical ranges. The house factored into those projections as a potential downsizing asset later in life. Equity could supplement retirement income if they sold and moved to a smaller property. Again, the value was real but deferred. Their monthly life remained structured around fixed costs. Mortgage, though closer to payoff, still required steady income. Property taxes had doubled since purchase. Insurance premiums reflected regional risk patterns. Utilities tracked seasonal extremes. Maintenance was ongoing. Owning the asset required ongoing cash commitment even as its theoretical value grew. The sense of being financially established coexisted with an awareness that most of their wealth was illiquid. They were asset rich relative to their younger selves and cash constrained relative to their balance sheet. When friends discussed early retirement or reduced schedules, the conversation inevitably turned to fixed obligations. A paid off home changed the equation for some. Others, who had moved to lower cost regions, carried smaller property tax burdens. Geographic decisions made years earlier shaped present flexibility. Their own decisions had followed a rational path: good school district, stable employment base, reasonable commute, historically appreciating housing market. None of it was speculative. Yet the structure locked in over time. As retirement approached within a decade, the house required another major expense: roof replacement. Insurance covered part after storm damage, but deductibles had risen in recent years. Out of pocket costs were substantial. They paid in cash to avoid adding debt so close to retirement. The equity statement that quarter showed another increase. The checking account showed the deduction. They noticed that conversations about wealth often emphasized accumulation: home equity, retirement balances, investment growth. Less often discussed was conversion. Turning assets into usable cash required transaction, timing, or depth. Each option carried friction. Even their brokerage account, modest compared to retirement balances, was mentally categorized as long-term capital. Selling investments to fund discretionary spending felt like dismantling future security. So liquidity remained narrow. The house stood solidly on its lot, well maintained, in a neighborhood that had aged with them. Children prepared to leave for college. Bedrooms would eventually sit empty. The mortgage would be paid off in a few years, eliminating the largest monthly payment. Property taxes and insurance would remain. Maintenance would continue. The asset would still require cash to sustain. They understood that much of American middle class wealth resides in primary residences. They were part of that pattern. Appreciation had rewarded patience. Tax advantages had reduced some costs over time. Stability had provided non financial benefits that were difficult to quantify: community continuity, predictable schooling, proximity to work. At the same time, ownership had concentrated their financial identity into something not easily moved or partially liquidated. In quieter moments, the realization was less about regret and more about structure. Wealth measured in net worth did not translate directly into flexibility. The two metrics diverged over time. Their balance sheet reflected decades of responsible decisions. Their cash flow reflected ongoing obligations attached to those decisions. When the final mortgage payment eventually processed, there would be a shift in monthly outflow. Property taxes would still arrive. Insurance would renew annually. repairs would not disappear. The house would continue to appreciate or fluctuate with the market. Its value would remain embedded until a sale or borrowing event. The equity statement would keep arriving. It would likely still sit unopened for a few days before being filed away with the rest of the documents that confirmed what they already knew. They owned a significant asset that required steady income to maintain, offered long-term security, and limited short-term maneuverability. The realization had settled in without fanfare. Asset ownership had strengthened their net worth and quietly tightened their liquidity at the same time. Both conditions were true, coexisting inside the same financial life.